Good afternoon, everybody. Today we are going to get into Chapter 10, and we are going to talk about risk management, specifically insurance. So, of course, life is full of risks. We can do our best to avoid any possible risks that are out there to ourselves and to our property, but we cannot eliminate all risk. So in that case, to try to help ourselves, we can pay somebody to share that risk, and that's why we have insurance. So different types of risk that are involved. We can have speculative risk, which we can avoid by simply not participating. I don't want to drown. Guess what? I'm not going to go into water to avoid that risk. We've got pure risks, the things that we can try to avoid. We can try to avoid getting sick to the best of our abilities. Still may be out of our control depending upon what we come into contact in our environment. And then, like we said, we can share it, and we can pay somebody to share it, and that's why we have insurance. So we can shift and share some of our risk for property, for our health, and on our income. So first off, we're going to talk about property and the different forms of property or types of property insurance that we can have. What all is going to go into that insurance. And the major pieces of property we'll talk about are a house and our car. So we've got our property risk, which would be the loss of use. We're not going to be able to use that property anymore because some sort of damage or accident has, or the loss of value in that asset because something happens. And then we've also got personal liability on ourselves for our role in the damage or damage to somebody else, and what we may be putting ourselves at risk through what can happen. So as far as that loss or use of value, we can have various weather hazards. There could be vandalism, there could be theft. And then as far as our personal liability, that we injured some other party or we damaged some other party's property. Like I said, the property that we're going to focus on in this chapter would be our home and our vehicles. So our home, we'd be worried about insuring the structure, the actual home, and whatever possessions we have in it. And they discuss those possessions being considered listed property here in the chapter, and that would be the same consideration if you're a renter. You're not really responsible for insuring the building, just your place that you're renting, your apartment, the value of whatever property you have inside that apartment. So they give us a list in our textbook of all different things that our home insurance covers. And you can see examples of that: fire, lightning, windstorm or hail, God forbid, explosion, damage by other vehicles, smoke, mischief, theft. You see here volcanic eruption, very key in Hawaii in the last couple of months for the people, unfortunately, that live near the volcanoes that were going out. You know, ice, snow, sleet, so things that can be important here in North Dakota, making sure we're covered from excess snowfall. Any issue happens to roofs, wind and hail damaging a roof, or unfortunately fire. Things that are not covered would be property for renters. You got to have a separate policy for that. Animals, business property. If you do a home-based business, you got to have a separate policy for that. And a couple of the big ones here: flood and earthquake. Once again, in North Dakota, earthquake, not a big deal, but depending upon your vicinity to a river, flooding could become very important to you from year to year. We've got the Goose River running through town that can then cause issues from time to time that the people in that area would have to have flood insurance for the risk that excess snowfall, excess melting rises the river, and then they get flooded and cause damage to their home. So what benefit can we get out of our insurance, unfortunately, if we have to claim it? Well, we're looking at the actual cash value or replacement cash value. And generally, the actual cash value is going to be less. What that piece of property is worth at that point in time, which is going to be generally a lot less than what you originally purchased for. Assets are going to depreciate in value. So that actual cash value, for example, would go down. Or you've got guaranteed replacement cost or extended replacement cost. If you can get what value it is to replace them currently. Guaranteed replacement cost would cover the full cost of replacing that asset. Extended replacement would be limited to a percentage. A percentage of that actual cash value. So they give us the example in the textbook, for instance, 125% of the cash value. So hopefully that extension would make up the difference between actual value and you getting a replacement. So different things that go into insuring your home is what's all your personal status, things that we've talked about previously, employment, credit history, and then also what's your history of insurance claims. Then we're looking at the property. How big is it? How old is it? Where are you? Where are you in location to, say, the firehouse? How many people you have in your home? What type of heating system do you have? How old is that heating system? And then what type of coverage you're going to have. So as far as replacement or actual cash value, what you have tied on for all your listed property, all your stuff, and then whether or not you have an umbrella policy, which more than likely you're going to have for your own personal liability if something happens to somebody on your property, some form of accident. So to cover that individual liability. And then you have the opportunity for various discounts. If you do have multiple policies with the same insurance company. You know, if you have all your, your property policies, if you have your vehicle policies, the same company as your home insurance, that can lower your cost. And then various risk preventing measures. Deadbolts, more important thing if you live in a bigger city. Having fire extinguishers, having a sprinkler system. Rare thing that's going to be in a house, more so a business property, but would be a possibility. How long you've been with the company, any improvements you've made, once again, you see, to electrical, heating, plumbing, to hopefully make it a less risky venture if those things are new. And then the other thing we're going to talk about is insuring your car. So we're insuring ourselves against bodily injury and that liability that people in our car are going to get hurt. They're going to require medical attention. To protect ourselves if we get involved with an uninsured motorist, and then whatever damage to our property, to their property, as far as that damage, or a comprehensive policy. So then covering all kinds of damage and value of the vehicle. So of course then, the insurance policy on your car, it's going to vary by, okay, what type of car do you buy? Or what type of car do you have? How nice it is? How old it is? And what safety features it has. Something that's newer, more valuable, is going to cost a lot more to insure than something older that does not have as much value. Then we got who's driving the car, age, gender, marital status, and the big thing, driving history then. You got tickets in your history, you got accidents in your history. So the more risky you are as a driver, the more that's going to cost you. The younger you are, the riskier you are as a driver, the more it's going to cost you. And then we've got how risky the environment that you're normally driving in. What's the risk of theft, vandalism, accidents? Once again, something's going to be more important in a bigger city that sees these things than necessarily in a place like Mayville, North Dakota. So once again, insurance, we have it to protect ourselves against liability, against damage to our property. They can be caused by various hazards, weather things, or theft or vandalism. We've got to take into account replacement cost or cash value, and all the different factors that go into the property that we're insuring and go into us and how risky we are as policyholders. So that can be with our home, that can be with our vehicles, and what all those risks are. And we're going to all have personal factors that are either going to increase our risk or decrease that risk depending upon our history, age, etc., driving record. Another big type of insurance that we have to have into our lives is health insurance. So we're going to talk about some of the various forms of health insurance or coverage that we can get out there. So we've got our basic health insurance that's going to cover going to the doctor, getting surgery, your prescription drugs. You can get additional policies for major illnesses or major types of injury. You can get cancer policies. You can get essentially something going along with having a heart attack. Policy for that. You can get additional coverage for things like eye coverage, dental coverage, etc. So we've got deductibles, amounts tied to your health care that you have to pay in throughout the year for the services that you take advantage of, or the claims that you have to the health insurance policy. As far as making sure that you have some skin in the game, and that's going to be made up of your share of paying for things, and also co-pays. So you're going to have to pay certain amounts for, say, a doctor's visit. They're going to make you pay $25. Or for a chiropractor visit, maybe you got to pay $35 or something that you're on the hook for to limit people from abusing their health insurance and going for every little thing. You've got to pay at least something. So we can get our health insurance from private organizations. Name all types of different medical insurance companies. Sanford Insurance being an example of a nonprofit. Blue Cross Blue Shield. I think also maybe set up as a nonprofit, or we've got HMOs and various different types of organizations set up for healthcare coverage. And then they all have various different rules, if you're part in these different companies, of what you must follow. So setting up, what doctors you can and cannot go to for your care, depending upon, like I said, the type of organization. So either we're going to be paying it or our employer is going to be paying it. Do the best you can to get a job where your employer is paying for your health insurance. That is worth its weight in gold to have somebody else paying these costs, at least for the policy. If not, you're going to be paying extensively. You could have additional things set up through your employer that you would pay into. Well, you could also pay into some for your main health plan if your employer requires that you're putting on some of the cost, but you can get additional things such as a flexible savings account, a health reimbursement account, or a health savings account. So an FSA, flexible savings account, you would set aside a certain amount of your salary at the beginning of the year that would go into this account. And then as you spend on various medical costs, that can get reimbursed to you from the FSA account. Any contributions to that plan would not be taxed, so that would be reduced from your salary and you're not taxed on that money. The major drawback of the FSA is that money expires. So after a certain date and time, whether it's a year, whether it's 15, 16 months, you got to use it or lose it. That money's gone. Where an HRA, that's funded by your employer to get reimbursed for medical costs. And you can use it, but if you are no longer working for that company, you can no longer have access to those funds. So it could be another benefit that your employer would add by them paying into it. Whereas an HSA, you pay into it. Once again, as you have medical costs, you can get them reimbursed by the HSA, or you might get a little debit card that you swipe at the drugstore, at the hospital. The money does not expire, so you have access to it the next year and the following years. And once again, your contributions are not taxed. So if it's can be set aside from your salary. So once again, it won't be taxable income. Or if you contribute to it outside of your employer, we have a deduction going back to tax code that we talked about a couple chapters ago, that would be a 4 AGI deduction on the bottom of your 1040 for whatever you contribute to an HSA. And you can do that, I believe, up to either March or April 15th of the following year to reduce your taxable income. And then we've got Medicare and Medicaid. Healthcare covered by the government. Of course, we have our withholdings for our FICA tax. Part of that is going to Medicare, which we would get once we turn 65. And then we've got additional plans that we can add on to Medicare for prescriptions and things like that. Whereas Medicaid can be any time, but it's based on need. So you more than likely have to be under a certain income level to draw off a Medicaid and have the government cover you with health insurance, or have some form of disability for that. Big thing that came into health care in the last handful of years was the Affordable Care Act, to try to ensure that everybody had health insurance. So it set up a marketplace where the government would give you a tax credit and pay to reduce the cost of your health insurance if you did not have it. Part of that was trying to make sure that people were covered with good coverage that did not limit them based on pre-existing conditions. It extended the age to where your children can be covered under your health plan to 26 instead of when they were done with school. And then also put into place a penalty for not having health insurance. So if you don't have any type of coverage, at the very least, look into this Affordable Care Act, look into healthcare.gov and this marketplace, and try to get some form of coverage at a reduced rate. Be very accurate as far as your income, so you do not have to pay the penalty, A, for getting too much tax credit than you really should have, or B, if you don't have it. For another year or two here, we still have penalties as part of your tax return. Thinking past into the future would be long-term care insurance. Long-term care insurance, we can get, essentially to care for ourselves when we are no longer able to care for ourselves. So, easy way to explain it would be nursing home insurance. If you do have to go into a nursing home someday because of your physical health and what care that you need, that can be very expensive. You can get insurance to help pay part of those costs. As far as what your costs will go into for that long-term care insurance is what age you are when you're looking at taking out the policy. The sooner you do that, the lower those costs are going to be. And they can get quite pricey if you wait till later on in life. But that's something that you'll look at through one of your homework questions. What type of coverage you're going to get, what your health is, and then trying to factor in inflation and what healthcare costs are going to be by the time you would get to the point of having to draw off of this. So all our different types of insurance that we covered here, health related. We've got our basic healthcare insurance. That's going to cover our costs of going to the hospital, medications, etc. We're going to have deductibles that we have to meet as part of our plan. We're going to have co-pays, etc. There's different insurance that we can obtain from other nonprofit or private organizations. If we do not have coverage, whether we do or do not, we have access to FSAs and HSAs. Would be the big ones out of that section. And then once we reach a certain age, we can qualify for Medicare and Medicaid, and we have the opportunity to take advantage of the Affordable Care Act as well. And then something that most people aren't thinking about at all right now, whatever age you are, long-term care insurance. Think down the road to what's going to happen once you get to a certain age. It can be up to 70, 80, 90, over $100,000 a year to care for somebody in a nursing home, as I've seen with a lot of my clients that are in that position. The last thing that we didn't really get into in the chapter here, you can also take a look at disability insurance. Once again, protecting yourselves, what we're getting into in the last part of the chapter here, disability insurance, trying to protect ourselves. We're going to talk a little bit about life insurance as well. So, trying to protect our income, what we have coming in month after month after month from our employment options. So we've got disability insurance so that if we get hurt and we're not able to work, we've still got something coming in and we can try to maintain our lifestyle. And a lot of different factors can go into what our disability insurance is going to cost. How long before that's going to take effect and it's going to start? What amount are you going to need to draw? What is your current salary? How long could you possibly draw these benefits for? What went into causing the disability? what different injuries that you have. Once again, inflation being factored in, and whether the policy is going to continue. So those are all things that we can add on to it if it's a specific illness or a specific accident, kind of like I mentioned before with a cancer policy. You know, looking at what type of accident, did you lose your hearing? Did you lose your vision? Did you suffer some sort of brain injury? All that stuff can be factored in to what your coverage is. And once again, as part of our homework, I want you to look into what a disability policy would cost. And the last part of protecting our income is life insurance. So do our loved ones that are left behind have the funds to be able to continue that lifestyle, to be able to factor in debt, factor in future plans as far as if you have children, providing for others. So as far as how much life insurance coverage we need, what are we going to cover? Do we have a mortgage currently? How much is that? Do we have other property that we have debt on? Vehicles, land, etc. How old are our children? Do we want them to go to college? Do we want to provide for them to go to college? How much income will our family be missing out on that we need to replace? Do we need to provide care for others in our family? Are we able to cover any medical expenses and a funeral? And then thinking ahead to any possible estate taxes. So we've got two different types of life insurance, term life insurance and whole life insurance. Whole life insurance can also be considered similar to an investment and a form of retirement planning. So term life insurance is set for a certain number of period and then it ends. So whether that be 10, 15, 20, 25 years, somewhere in that ballpark, it ends. It has no cash value, I do not believe. So it's like the other forms of insurance. Unless you claim it, you're not getting anything out of it. Whereas whole life's a little different when you're paying into a whole life policy. You've got various benefits there, and you've got a cash replacement value that you can take at any time that you'd like. We've got different forms of a whole life policy. A variable life policy has you set up for a minimum death benefit. You're guaranteed to get whatever that set amount is. An adjustable life policy, you can change what that benefit is as your needs change, as I suppose your family grows, or as you take on different things that may need to be covered in the future. And then also a universal policy, you can do different changes to it as you go. And a benefit of the whole policy, I mean, you could use it to borrow against it when you're looking for a down payment for your first home. You could get to a certain point in the future and just cash it out and use it essentially like a retirement account. And you can get that cash value. The longer that you pay into it, obviously that cash value is going to go up until the later in life you get, as close as it'll be very close to then what the defined benefit that you are to gain from the policy. So maybe you can take advantage of that money before you die, if you so choose. You've got various riders that go into your whole policy. So different clauses that can add to your benefits in the future. And then once you get to drawing off of it, you can choose how do you want to get that money. You can get it into a lump sum, you can get it in installments, etc., until you collect the whole thing. So you can kind of decide then what is most important for you. How much do you have to cover? What do you need to be prepared for in the future? As far as whether you need less life insurance coverage or you need more life insurance coverage. You know, through going through this stuff and reading it and thinking about it, I got to consider, do I need more to protect my family in case anything could happen to me? So once again, things to protect ourselves, we got disability insurance or life insurance. So you can look into disability insurance and protecting yourself if something happens to you and you are unable to work, or if something even more drastic that happens to you and you want to protect your family with the same level of income that you had going previously. You can look at various forms of life insurance. So that is Chapter 10. Thanks for listening.